Today we're going to talk about why I'm still excited about property investing in 2022, and we're going to do a quick SWOT analysis. So SWOT analysis is strengths, weaknesses, opportunities, and threats. There's a lot of negative talk about property investing and property investors in the media at the moment. So what we want to do is to try and be objective as we can and go through points one by one and assess if we're still keen on property investing in 2022. So starting with S, what's the strengths of property investing? Well, simply there's a lack of really good alternatives for investing unless you're more of a sophisticated investor. Investing in stocks in a big way limits you to the capital you've got. There's very little use of leverage. Buying businesses is inherently more risky. Cryptocurrency is another one. There's obvious risks there. You wouldn't want to, most people put all your eggs in one basket just in the crypto side of things. So the lack of alternatives brings us back to property investing. Property investing is proven, it's historical, it's tangible, it's easily understood, and it's consistent cash flow over a very, very long time. So property investing is strong, and that's buoyed by the fact that there are other alternatives probably not for everyone. There's still low supply in the New Zealand market, especially in the main areas, and even though there's RMA changes, it's still going to take a long time for a lot of new houses to get built. It's not so much that we're short on land or short on opportunity of places to build properties. It's the labour shortage, and the labour shortage in Australia becomes more obvious and pronounced. Then a lot of the people that are building houses for us in New Zealand are going to be building houses over in Aussie, and the labour shortage is going to get even tighter, which makes it really great if you already own properties or if you're looking to buy before that hits us. Now, interest rates are going up, and some people would deem that as like a risk or like a weakness of property investing. And I would challenge that assumption, because what's going to happen is as interest rates go up, say they go from an average of 3% up to say 6% over the next year or so, it doesn't really matter as long as you're focusing on cash flow. And what most investors on average are going to do is have to focus more on cash flow because of the negative gearing being so strong as the rates go up. What does that mean? What does that lead to? People are going to flood probably more into the regions, even more than they have already. That inflates the prices up in those areas, which again inflates prices up in the major areas. If somebody's got $1 million to spend, but they want it to cash flow in a really strong way, and they, instead of looking in Auckland, they start looking in, say, Rotorua, that demand in Rotorua does filter out throughout the whole market, and it pushes prices up everywhere. Interest rates going up doesn't necessarily mean in the short, medium term that prices are going to go down. It actually even can push prices up, because property investors are actually still keen to invest, they just choose different areas. Now, obviously that's not all of the strengths of property investing, but if we move on to the weaknesses for 2022 property investing, now obviously there's been an economic impact because of what's been going on in the last 18 months. New Zealand economy is still performing well, relatively speaking, because of the $100 billion plus that's been pumped in by the government that was not expected. Having said that, the economy might be a lot weaker next year if these businesses that have gone into liquidation or receivership, there's no new businesses to get started up. The economic impact of having less money moving around and more money coming in from tourism or education, our exports, that generally does impact the housing market. Whether that negative weighting coming in will act against the strengths, time will tell. Now, another weakness of property investing in 2022 is that over the last sort of 10 years, the movement in data on inflation and interest rates and all of the data points that we've come to rely on to help project out into the future, there's a lot more volatility and unexpected things happening. For example, in inflation, there was pretty relatively low inflation for a long time, and boom, it's just shot up. Now, the data that we're working off is often 3-6 months old, so it's hard to make those decisions when there's a new trend line in there. So a weakness of property investing in 2022 is you're often having to make information off old data that may be changing. What are the opportunities for property investing in 2022? Inflation makes it harder for people to understand the nominal values and to change prices accordingly. So when inflation is, say, 5, 6, 7%, it's really hard for people to figure out what things should actually be priced in terms of replacement costs and in terms of their true nominal value. And sometimes there's like arbitrage opportunity, and we've seen property investors in the past do really well in inflationary times, even when interest rates are high, because of the leveraged effect that you're getting with property investing. It's the same with opportunities for debt to income ratios if they come in a big way. If the DTIs or debt to income ratios start knocking other property investors out of the market, or even first home buyers, it is an opportunity for established investors or the investors that are making a bit more money to come into the market and start picking up deals in a less contested way. If you're not earning that much money, debt to income does obviously impact you, but if you are in a strong position, it is a great opportunity if they come in. Now, the last part of a SWOT analysis is the threats. Now, threats to property investing next year are political instability. Now, there's been a lot of political unrest in the last sort of 6 to 12 months. Just with a new national leader coming in, I think that there's going to be more political stability and more checks and balances, and the power struggle will become more to the center. Having said that, a lot, the saying goes, can happen in a week with politics. So politically, there's definitely a threat there with instability, and it's the same with social side of things. There seems to be a lot of hate in the media against property investors and about ambitious people that want to own more than one property. So you just need to be careful there that the tide doesn't swing even further towards having property investors having less rights and renters having even more. And I'm all for fairness in that space, but define fair. Now, one other curveball threat, for example, is, let's say we have really high inflation and the wage growth doesn't keep up with it. Then in other parts of the world, we have seen rent controls being put into place. Essentially, the government or the local body is telling you how much you can charge for rent and how often you can increase it. That does obviously impact values and returns. So you just want to be mindful you factor that in if you buy a property expecting this amount of rent and increasing it regularly, and then something gets put on you that you can't. Now, as always, and even more important than normal in the last 5 years, is going to be cash flow on your portfolio. You really got to measure out what your cash flow is going to be in certain circumstances and make sure that you're not forced to sell when timing not necessarily the best. So focus on cash flow. Now, maybe the next few years is not going to be as strong a period of capital gains as we've seen in the last 10 years. Having said that, this is a long-term game, and your lack of better alternatives for your centralized investment strategy does tend to push a lot of people into property. So any questions or comments, let me know below. I'd love to hear what you think about what's going to happen next year.